Well, very wonderful good morning to everybody. And I'm sure some of you are thinking, thank God it's Friday. I know the feeling. And that's why this morning we are off to a power-packed start. I am sure that many of you, like myself, are still enjoying a warm beverage this morning, perhaps a hot cup of tea or a hot cup of coffee. So while we get ready to take in all that will be imparted by Mr. Robert Moncrieff, Robert is the Global Insurance International and Transactions Tax Services Leader for Ernst & Young and the Economic Substance and BPS Leader for the BBC region of the Bahamas, Bermuda, British Virgin Islands, and Cayman Islands. Clearly, when I wake up in the morning, I'm very tongue-tied. He has over 3 decades experience in the industry and has held several senior executive positions. Thank you, Robert, for being with us this early Friday morning. Over to you.
Thank you, Wendy. Good morning, everybody. And thank you very much for being up so early to follow through with this. I think the idea here is that it's very much everything you need to know. This is a big subject, and I think if we can get to touch some of the main points here about what this program is all about, when it's going to happen, what it might mean for business globally and in the region, and take from there whether you need to act now. The answer is always going to be yes. If you're a professional advisor, we don't tell people don't worry about it. But more importantly, you know, what's in front of us and what do we have to do in the coming months? So we can move to the slide picture. Is that what you can see now? So the minimum tax, which is the headline issue that everybody will ultimately have to pay at least 15%, is really part of a much bigger program. It is the base erosion and profit shifting program from the OECD that had its first round back in 2015. And many of the jurisdictions that you folks operate in and that we operate in the northern parts of the Caribbean and Bermuda, we felt some impact to that first round in the form of mandatory rules on economic substance and the like. Here, the second round was split into 2 main initiatives, pillars 1 and 2, and it was dressed up initially as something to deal with the new digital economy, meaning that countries that have a huge consumer base, mainly in Asia, were upset that their companies providing those services, which were US technology companies, were really not paying very much tax in the user jurisdictions because they were supplying those services online. And so pillar 1 is all about reallocating some of the profits of these very powerful technology companies and digital sales companies into the user jurisdiction versus the supplier jurisdiction. The second pillar really has nothing to do with digital tax whatsoever, and that's the one that we're talking about today, and that is the proposal for a global minimum tax. This actually started out as a base erosion measure. In other words, it wasn't so much a problem that you didn't pay a lot of tax. It was a problem if you didn't pay a lot of tax because you were siphoning income out of high tax countries. That's what base erosion is about. But actually, it's really morphed into an anti-tax competition measure so that even if you're not paying a lot of tax, but it's not derived from related parties, it's just derived from doing business in a particular jurisdiction, that could still be an issue. So it has changed in character and moved a long, long way from just being a base erosion issue. There is an expectation that I say final draft is a bit of a contradiction, but it's inherently draft. Nothing is done with the OECD until everything is done. And the idea of it being final is that that's where the OECD stops by producing some draft legislation and letting countries look at it and implement it their own way. That's expected towards the end of November. And the aim is that the implementation of these rules at the jurisdictional level, i.e. by each country that wants to do so, will be during 2022 and will have an initial effective date of 2023. Many jurisdictions say that that's not possible because their legislative framework just simply doesn't allow for that speed of implementation. Others say that it's very ambitious. I think the OECD knows that it's very ambitious. It's also, you know, just to reiterate, the OECD is not a lawmaking body. It's not even a minimum standards body. It is a best practices body. So it operates by consensus. So they get countries together and countries say, we agree this is a good initiative. We agree these will be the key parts of this initiative. But as to how it is implemented, that is done by, by consensus as opposed to any legislative force or jurisdictional force. And so that's why a number of countries say that it's ambitious. The final point is probably very important to the audience here, and that's that the rules are limited in application to some degree. They only apply to multinational enterprises, and that means exactly what it says, that you operate with a taxable presence in more than one jurisdiction, even if it's just a branch. So a Jamaican company with a Barbados branch is a multinational. A Jamaican company with no foreign footprint or just representative offices overseas is not. And you have to have consolidated revenues. The top line of the consolidated financials has to be no less than 750 million euros. I think they've stuck to that. You know, it's the same threshold as country by country reporting, a previous OECD initiative, and there's usually a US equivalent of 850 million US dollars applied there. But if you are not at that level, and I think you have to hit those levels for at least 2 out of the last 4 years, you're not in scope here, and you don't need to worry about the rules. There is likely also to be a deferred application of the rules, even if you are in that threshold, if you only operate in 5 or fewer countries outside your home country. This is a new measure that's been being considered in these rules to protect companies that are in the initial stages of being truly international. There is another requirement that you have no more than 50 million tangible fixed assets offshore, but for financial services entities, that's really not very difficult. We suffer in most of the other areas of these rules by not having financial capital and regulated capital being considered a real asset which we use to make money. But here it's beneficial because the focus is on tangible fixed assets being the engine of revenue production and value. And that simply isn't our engine in financial services. The first point here is very much of what you need to know, and I apologize if everybody's already aware of this, but if you read the press reporting, it says everybody signed up for this. Well, there are 140 countries in the OECD's inclusive framework, and 136 of those 140 signed up. In other words, they agreed, or rather did not dissent from, the inclusive framework statement, which was this public document. There was one in July and another one relatively recently in October. And by signing up, it does not mean that the jurisdiction must implement the minimum tax. It doesn't mean that if you signed up, a 15% corporate income tax is going to be relevant. The only 2 jurisdictions I'm aware of who have immediately decided to introduce a tax for those in scope are Ireland and the Bahamas. And that still has somewhere to go. But it just means that you agree that if you, as a jurisdiction, if you do choose to implement a corporate income tax or you do choose to implement these rules, then you will do so in the same way as the model and the same way everyone else is doing it. And further, you agree that other countries have the right to implement those rules against you. You will not object if another jurisdiction insists on applying the principles which do not necessarily work well for you. So there's a 2-stage process by which these rules work. And don't worry too much about the granularity here. The principle is that you take your global group and you break it into jurisdictions, and you break the consolidated numbers up so that you have 2 numbers for each jurisdiction. You have the pre-tax profit and you have the amount of tax. Now, those are not just straight numbers pulled from the financials. There are calculations that take pieces and add pieces, but essentially you're trying to arrive at an effective tax rate by country. And if that rate is above or equal to 15%, there's nothing else to do in relation to that jurisdiction in terms of worrying about whether it gives rise to a concern. But if it's below 15, then that creates an amount of, I call it missing tax because that makes more sense to me, but it's called top-up tax in the rules. So in other words, if you operate in a 0 tax jurisdiction and you made $100 of pre-tax income and you paid no tax, then the expectation is that you should be paying 15 on that $100. And if you paid 0, then there is 15 of top-up tax that has to be collected by somebody. The first round of collection operates at the parent company level if the parent has implemented these rules. And the parent will apply something called the income inclusion rule, which essentially says, I'm a parent jurisdiction, I've implemented these rules, I have a subsidiary that paid no tax on $100 of income, so there's 15 of tax due, and the parent will collect that 15 of tax, will pay that 15 of tax in its parent jurisdiction. And it does so by whatever tax rate the parent has, it assesses taxable income to collect that top-up tax. So if the parent is a jurisdiction that also has a 15% tax rate, then it simply adds another $100 to its taxable income and pays that extra 15. If the parent is in a jurisdiction that chooses not to apply these rules and does not impose an income inclusion rule, then obviously it's not going to collect that $15. Then things get slightly more complicated because they have to work out who is going to pay the 15. And the way it works is that that 15 is allocated across all of the other jurisdictions who are not themselves low taxed in the subsidiaries. And it's allocated based on the amount of tangible fixed assets they have and the number of people they have, or rather the payroll. So you could have three subsidiaries outside the parent, and as long as they themselves are not low taxed, I'm not sure, excuse me, why Outlook is choosing to open. As long as those entities themselves are not low taxed, they will get allocated a share of that $15. And they can then collect that 15 by denying tax deductions or forcing an income inclusion. The last sentence is there really to give you an indication that although we've been working on this for 18 months or so, the actual mechanism for the collection is still not determined. And it is likely that when you see this as a two-step process, it is likely it will be implemented in two steps. In other words, that the income inclusion rule is supposed to be the prime mechanism for collecting all of this missing tax that the industrialized countries think we ought to be paying in low tax jurisdictions. And this backup rule, which is called the undertax payment rule, is not going to be implemented straight away. It will be implemented a year later. And the thinking here is very much that although the OECD is prepared to say we respect the sovereignty of smaller jurisdictions or island jurisdictions or financial services jurisdictions to collect tax their own way, we will nonetheless have the right to collect tax that we think they should be paying that they're not. And they think the income inclusion rule, which is simply saying if you don't collect tax, somebody else will collect it for you, is going to be effective in forcing jurisdictions to consider taxation. And I think politically there has been a lot of pushback from the island jurisdictions that don't have a rate at 15% to say, well, it's not that we choose not to collect tax, it's just it's not a particularly sensible mechanism for a financial services dominant economy. In my jurisdiction, Bermuda, our government revenue depends quite heavily on the performance of the reinsurance industry. It would be madness to base your government revenue on such a volatile return. Similarly, a lot of us collect our government revenues through fees, license payments, company registration fees, as well as a moderate corporate income tax on the profits of companies. And when you look at tax as a percentage of GDP in these islands, it's comparable to the European Union countries who choose to collect it through corporate tax. But that is the way these rules are going to work. We suffer the fact that we may have to suffer additional tax somewhere in the group. And the mechanism under which that will happen is likely to be primarily the tax at the parent level, but for parents that don't implement the rules, it'll be tax at the subsidiary level. So the key takeaways from all of this, number one is, and this is not to imply complacency, but it is to say, don't worry too much. The rules are complicated. The details are still not final. I mentioned a point earlier on, which I will elaborate here. The second bullet there, it is important that there are two pillars here, the digital tax rule that I mentioned before, and this minimum tax, because the two have to stand together or fall together. And you have a broad distinction in that the United States objects or does not like Pillar 1 because the burden of this digital tax will fall predominantly on the US. They do, however, like the minimum tax because the US standard approach to tax competition is not to lower their own rates, it's to make everyone else raise theirs because they need to keep the US rates high. So the US is very much a strong advocate of Pillar 2 and is looking to push through legislation to get that in place, has already indicated it may not be able to look at Pillar 1 until next year, and maybe not until mid next year. And that's largely because Pillar 1, the way that this digital tax agreement will work is on a multilateral basis, and it requires a multi-jurisdictional contract. And that will take time. And in the US, as a legislative matter, that requires going through the congressional/parliamentary process. And the US, as things stand, does not have a sufficient governmental majority to make that simple. So the point there is that until the US demonstrates strong commitment to, and in fact starts the process of implementing the digital services tax equivalent, things may stall on the other pillar. So everybody needs to be moving at the same speed, and we still have some details to finalize. It's worth bearing in mind yet again, it's only going to apply to multinationals with group revenues over 750 million euros. In terms of what it means economically, we think it's unlikely to shift business at this stage. It is unlikely to cause people to disinvest, divest, and move money elsewhere. There's a couple of reasons for that. The first is, where are you going to go? Because this is a global minimum. And in most cases, jurisdiction choices are not going to be made based on tax anymore, to the extent they are already. They're going to be made based on the access to talent, the relationship with the regulator in the case of regulated financial services, the ability to do business, the ease of doing business, and the attractiveness of the local market. Those things are not going to be heavily impacted, we think. And so, as with any form of tax, taxes aren't paid by companies, they're paid by people. And so, direct tax costs increasing on companies find their way to individuals in the form of price increases, whether those are direct or indirect. And so the cost of doing business goes up, the cost of of goods and services goes up. And what we suggest, therefore, in terms of how to approach this is very much an iterative process. You have to keep an eye on what's going on, monitor the developments, particularly if there is a change in the thresholds or the scope. Evaluate what the impact might be. Is this really relevant to my jurisdiction or the jurisdictions in which I operate? Do a little bit of modeling. I mean, that's been hard so far. People like to model when there's huge initiatives, but when there are so many alternatives and moving parts, it's quite hard to model and do what-if analysis because there are so many alternatives. That is narrowing quite a lot now that the rules are entering their final phases. And you probably can, to the extent you're in these rules, do a sensible model to say, okay, this is what's going to happen. We expect we're going to have to pay a little bit more tax, and we may have some control over where we pay that. And for some jurisdictions, and I don't have any particular jurisdiction in mind, but they may decide, hey, the impact of these rules is that I have to pay another $100 of tax a year outside my home country. Why don't I pay it in my home country? I may get more benefit from paying it at home rather than paying it offshore. And there are still some issues for regulated businesses who generally have their capital and surplus heavily regulated as to how do they square this with the regulatory authorities that they have to pay some more tax allocated to them based on the tax regime in one of their affiliates. It's nothing to do with them. You're in a given jurisdiction, you do business locally, you don't do business with any of your affiliates or very little, and yet you're called upon to pay more tax because one of your affiliates isn't paying as much. That is going to prove to be operationally quite a struggle. So model out your alternatives, keep your stakeholders informed, keep them knowledgeable about what's going on, and then back to the beginning, keep an eye on it. It's just a question of staying connected until these things become final. And I don't think we're going to see a uniform adoption at the end of next year, early 2023. I think it's more likely to be a year after. There are a lot of factors in here that could derail pieces of it. I don't think it is safe to say the whole thing will fall apart. That's also very imprudent, I suspect. It could, but I think it's much more likely we will see some jurisdictions less willing, some will adopt it. The European Union will adopt it in the way that they do on a group basis. The US, it's very much up to the legislative program that's in place at the moment and whether they can get things done in the next 6 months or so, because the character of Congress will change. It's almost certain that control will move away from the incumbent party. It always does in early elections or midterms. And so we could see some changes there, but it's important to stay on top of it. And to the extent you're in scope, have a sense of how it's going to apply. Regulated businesses do not move quickly. So to the extent there's a result that you really need to address in the form of restructuring, God forbid, then you can at least get the runway for that looking. But that's really where we are. And it would be great to have this conversation this time next year and still be in the same place, because I don't think any of us really wants this outside the major European jurisdictions in the US. But I suspect we'll be in a different place. But we're working hard to ensure that the impact is as contained as it can be. And that's where we are. I'd be very happy to answer any questions.
Oh, very good. Thank you so much, Robert. Let's see if we have any questions streaming in from the audience, but I think that was a really very informative presentation. And certainly there's a lot, obviously, that from a banking perspective, we needed to be aware of or need to be aware of as we chart the way forward. So let's break for a minute, see if we get any questions coming in. Okay, so Robert, here's a question for you. How soon is this likely to be implemented or felt within the region? We know that these things take a little time sometimes to filter down. And I know that you said particularly the international banks are more likely to be impacted as parent companies. How soon are we likely to feel the impact, and what could possibly be the bottom line impact as well?
Or the earliest likely possible date that the rules would start to apply would be January 2023, and I think that's optimistic. In other words, that's when the rules will be effective, and then any tax impact of that would be felt likely the following year when the tax that's now becoming due becomes payable. I would think, I have a general impression that countries like Canada, who may be currently able to exclude or not tax the profits of businesses in the Caribbean that they own, that may change. So there may be incremental Canadian tax. But again, like I say, will that mean that they divest? No. There's a reason that there's a business in the islands, wherever you are, and it would take a catastrophic tax cost to change the dynamics there, I think. And I don't think a 15%, that was why we were very anxious that 15 was never increased to 20. 20 is it's a significant amount of money. 15 is not insignificant, but it's sustainable. So I think the multinationals are the only people in scope here that are owned. So the correspondent banking and the trust banking, etc., that is owned by full rate taxable jurisdictions who are not currently taxing those operations. So the US ones probably are being taxed, but the Canadian owned and the European owned may not be. They will have an increase in tax costs likely. The regional ones, well, there may not be an issue there, because unless you're operating in a taxable jurisdiction, the impact could be quite low. And if this 5 or fewer rule comes in, so if your footprint is only in 4 countries plus the home country, you at least have another 5 years before the rules come into play. But again, it's good that there's deferral. It's good that you may not be in scope, but it's important, to keep an eye on it. You don't need to worry about it, but don't be complacent and say it's going to go. And actually, we've found in terms of readiness that quite a lot of groups in other jurisdictions have been saying, well, this won't happen unless the US is on board, and we're not really sure that the US is on board, so we're not going to do anything. And that works for a while, and that's been a reasonable approach for a while, but I don't think it's the right way to look at it now.
Okay, absolutely. Well, it's definitely something that we need to keep in scope. I imagine that there would be some, there would need to be some strategic objectives and certainly a path in terms of how these costs will impact bottom line and how we absorb them, or what plans will be put in place. 15% or 20%, like you rightly said, are not insignificant amounts. Okay, so Robert, I want to thank you so much for kicking us off this morning. It's been an absolute pleasure, and I'm almost certain that I'll be reaching out to you again, perhaps to expand the discussions a little bit more as we move forward into this global tax regime for planning purposes. So again, thank you so much for joining us, and hopefully you can join us throughout the course of the day as well.
Yeah, enjoy the day. All right.
Thank you.
Everybody.
Take care. Bye-bye. All right, everyone. That certainly was a very informative session, something that we all need to keep our eyes on. It is good to know that there is a deferral being planned presently, but certainly, as Robert indicated, it may very well be something that's coming, that will hit the table again, and that we need to plan for, because the bottom line impact and perhaps even deferral costs are something that we need to be taking into consideration. So with that, we will break again for a half hour. I invite you to visit our sponsor booths. I remind you also that FIBA has been very generous in allowing 8 CPE points to every member attending the CAB conference, or everyone who attends in the audience. And we know that that goes a long way with your AML compliance, and certainly when your auditors come in as well. So as always, we want to say a special shout out to our sponsors this morning. We know that there may have been some issues with the group chat, allowing you to actually speak with them during the course of the day yesterday. That is under review, but in the interim, please send them an email or send them a contact note. You can also leave your contact cards with them. We've also installed for you a photo link in the group chat. So as you look to the top left-hand corner of your screen, you would see the chat located in there. Please visit the photo link, send us a picture of yourself so that we can create some beautiful memories of and with you. So special shout out this morning to our diamond sponsors, Howden, Hitachi, and Republic PC Limited. Our platinum sponsors, Raymond James, Ibis and Thunes, Finacle or Infosys, and MC Systems. Our gold sponsors, Temenos, Ernst & Young, J. Begas and Company Limited, and Ictual. And our green sponsors, CRS, FATCA 1, Firemines, and Sterling Asset Management. Thank you always for showing your confidence in CAB, and we look forward to working with you. We certainly look forward to hosting you in person in 2022. Thanks again, everyone, and see you in just a few minutes. Have a wonderful morning.